Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing FuelCell stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 458 million market cap. They're trading at 92 cents a share and they have 498 million shares outstanding. FuelCell manufactures and sells stationary fuel cell and electrolysis platforms that decarbonize power and produce hydrogen. They also offer technology to produce electricity, heat, hydrogen, and water. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Negative free cash flow every single year, and it seems to be getting worse. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every single year. Revenue is sales for the company, and that went up 88% from 2021 to 2022. That was its peak, 130 million. Then downhill since then to 123 million in 2023, 103 million in the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $352 million. We divide that by 498 million shares. And we get a calculated stock price of 71 cents. They're trading at 92 cents, so they're trading at a 30% premium. It's a sell according to the model. It's another hard stock to value because they have negative free cash flow. I gave them a pretty conservative revenue growth over the next few years, but even with that growth, I only come up with 80 million of free cash flow by 2027. So they still seem overvalued, but it's unlikely the stock will be 71 cents in a few years. Either it'll be like 20 bucks or they'll be out of business. There are 26 companies in the same industry as FuelCell, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 88 million in capex. These are the investments in property, plant, and equipment. They have a good debt to equity ratio, 0.2. Negative free cash flow, a lot worse than the median and average. The median is negative. They rank 19th in market cap. They cracked the top 20. Price to book looks good. It's below 1. Which implies the company is worth more in bankruptcy than as an operating entity. We can't look at their PE or price to free cash flow. Price to sales is 4.4 between the median and average. They generate $100 million of revenue, a lot less than the average, but more than the median. And their 5-year annual revenue growth rate is a little better than median. They're at 9%, median is 8%. If you put $10,000 into this company 10 years ago, what were you thinking? Down 99.7%. Let's take a look at their income statement. This is a 3 months ending 4/30/2023 and a 3 months ending 4/30/2024. I try to understand how a company generates revenue, so let's dig into that number. It went down. It was 38 million last year, now it's 22 million. They don't have any product revenue. 1.4 million of service revenue, down from 26 million. Generation is up from 8.4 million to 14 million. Advanced technologies 3.7 million to 6.9 million. So there's a little information on how they generate revenue. Let's see if they give a little more. Let's search for this number. This shows us percentages. So their revenue went down 42%. Cost of revenue went down 34%. So their gross margins are a lot worse. Last year was negative 16%. Now it's negative 32%. They had no product revenue this quarter, same thing last year. But they do have expenses tied to product revenue. So it looks like they're making things, just not selling it. Service agreement revenue was 26 million, now it's 1.4 million. So that's down 95% from last year. But they do have positive gross profit. It was 6 million last year. That's down 98% to 100,000. The decrease in service agreements revenue was driven by the fact that there were no module exchanges during the quarter. Last year, there were 8 new module exchanges at the plants owned by Korea Southern Power Company in Korea. And that started operating in 2018. Generation revenues went from 8 million to 14 million. The increase reflects revenue of 800,000 generated by the Toyota project, which became operational in the first quarter of 2024. Also, revenue of 4.6 million generated by the 14 megawatt Derby fuel cell project and the 2.8 megawatt SCEF fuel cell project. SCEF stands for Connecticut's Shared Clean Energy Facility, and both of these projects became operational in December 2023. They also had revenue from PPAs for the sale of hydrogen from the Toyota project. Advanced Technologies looks good. It was 3.7 million, now it's almost 7 million. Good margins, 44%. Gross margin is gross profit, 3 million over revenue. Advanced Technology contract revenues were recognized under their joint development agreement with ExxonMobil Technology. This also includes revenue from Esso Nederland, an affiliate of Emtech and ExxonMobil Corp. In order to generate the 22 million of revenue, it cost them 29 million, so they have a gross loss of 7 million. Operating expenses are 34 million. Admin and selling expenses 18 million. Part of admin and selling expenses is payroll, like in sales and marketing. Then they have 31 million of R&D expenses. R&D increased 17 million. This was mainly due to an increase in spending for labor and materials. This is related to their solid oxide power generation and electrolysis platforms and carbon separation and carbon recovery solutions. They have an operating loss of 42 million, worse than last year at 36 million. 2.3 million of interest on their debt. Net loss of 38 million, last year at 34 million. And they increased their shares outstanding. It was 406 million last year, now it's 453 million. Here's their income statement for the trailing 6 months. That's also down a lot. Revenue 75 million, now it's 39 million. Still no product revenue, but last year there was 9 million product revenue. Let's look at the statement of cash flows. This is for the trailing 6 months. The first section is operating cash flow. Last year they lost 89 million of cash, now it's 95 million. So operating cash flow is their net loss, plus the non-cash items on the income statement. Depreciation and amortization is the biggest, 18 million. And then we have to adjust for changes in working capital. A lot of cash outflows. The biggest was inventory, cash outflow of 29 million. But last year they had a cash inflow of 3.6 million, so that means they sold more inventory than they bought. In their investing section, they spent 24 million of CapEx. In their financing section, they paid down 5.2 million of debt. They added 13 million of debt. They received 25 million from their non-controlling interest. A non-controlling interest is an equity owner that owns less than 50% of the stock. If you own shares in the stock, you're a non-controlling interest. But companies they list in this section usually own between 5 and 10% of another company. So if you looked on Coke's balance sheet, you'll see Berkshire Hathaway, non-controlling interest. They added 6 million of common stock last year, 2.7 million. And it looks like they have preferred stockholders because they paid 1.6 million of dividends. A company has to pay dividends to preferred shareholders, but they don't have to pay dividends to common shareholders. It's at the company's discretion to pay dividends to common shareholders. Let's look at a company on Simply Wall Street. Its last price 82 cents, 441 million market cap, down 6% in the past week. Getting crushed in the past year, down 68%. Look at this stock chart. The stock was 18 cents at its low. With reverse stock splits, it was over $7,000. Even in the past year, it's gone down a lot. Unless you timed this stock perfectly, you would have lost money. At the end of May, the company received notice from the NASDAQ that they may become delisted if their shares do not trade above $1. If the stock price falls below $1 for 30 consecutive days, a company's at risk of becoming delisted. Some companies trade below $1 for a long time and they don't get delisted. I think other factors are involved, like revenue, market cap, things like that. So they have until November 27th to regain compliance. Either the stock price needs to go up a lot or they do a reverse stock split. To regain compliance, they have to be above $1 for 10 consecutive days during the next 6 months. If a company does not regain compliance with the NASDAQ rules, they may be eligible for another 180 days. Delisting doesn't mean the company goes bankrupt. It just means they trade OTC, over the counter. So you can still buy and sell the stock, it's just a little less liquidity. And the rules are a lot more lenient OTC. When I say more lenient, I mean in terms of financial reporting and compliance reporting. Look at that, they got MJ on the board. Michael Jordan. That's going to help the stock price. Jordan's extensive experience in operations, advanced manufacturing, commercialization, and global leadership will be a significant asset to the company's board. On April 23rd, the price is right for FuelCell after diving 29%. The company is walking on a tightrope. They are entering a critical phase as it tests its carbon capture technology and scales its hydrogen fuel technology. The demand for clean energy hydrogen is projected to grow. FuelCell needs to accelerate their scaling efforts as competitors enter and secure hydrogen and ammonia supply contracts domestically. 7 analysts priced this stock at $139, so they say it's undervalued. There are no revenue forecasts for the company, but free cash flow forecasts are negative in 2024, negative in 2025, and negative in 2026. This red line is their debt, the blue line is their equity. So it looks like their debt is a lot lower than their equity, at least currently. Equity of $700 million, debt of $122 million. But it's not like they're selling products and making money. They're just diluting shareholders. This green line is their cash. It looks like they have a pretty good runway, $260 million of cash. The CEO's total compensation was only $91,000 in 2019, up to $500,000 in 2020. Now it's $560,000. Total compensation $5 million, tenure as CEO 4.8 years. The tenure equals the compensation. They're both 4.8. 60% of the company is owned by the general public and 39% by institutions. Their biggest shareholder is Vanguard, then BlackRock, Invesco 1.2%. The Swiss asset manager ZKB owns 0.5%. TIA-CREF owns 0.4%. BNY Asset Management 0.3%. And their employee count is pretty low, only 664 in 2013, now it's 591. And the ticker trades on the Nasdaq, Deutsche Börse, Xetra, London Stock Exchange, Wiener Börse, Mexican Bolsa, Bulgaria, EuroTLX. And it looks like they have preferred shares on the pink sheets. Let's see what they say about the company on Wikipedia. It's headquartered in Danbury, Connecticut. They're one of the biggest fuel cell manufacturers in the US. They provide clean energy in over 50 locations all over the world. They operate the largest fuel cell park in South Korea. The park consists of 21 power plants providing 59 megawatt of electricity, plus district heating to a number of customers in South Korea. They also operate the largest fuel cell park in North America, consisting of 5 2.8 megawatt power plants and a Rankine cycle turbine, and that's located in Bridgeport, Connecticut. Their customer base covers commercial and industrial enterprises, including utility companies, municipalities, and universities. They were founded a long time ago in 1969. From the 1970s to 1990s, they were sponsored by the US military. They IPO'd in 1992, and they spun off their battery division, FCEL, in 1999. FCEL is trading at 75 cents, 49 million market cap, so a really tiny company. After 1 year of trading, that stock was $25. That was in the beginning of 2000. Then a little over 1 year later, it fell to below $1. Their trailing 12-month revenue is $58 million, and they have positive $6.8 million of net income. With positive free cash flow, maybe this is a good investment. They started expanding globally in 2007 with a partnership with POSCO Energy. POSCO is a South Korean steel manufacturer. So they're really focused in South Korea, but they did terminate that partnership in 2020. In 2012, they established a fuel cell factory in Germany. They completed a joint venture with a German company and acquired Versa Power Systems. But a joint venture is separate companies. The companies stay separate, but they just focus on one particular thing, and they share in the profits depending on how much they invested. With a normal business partnership or combination, the companies that come together become one new company. In a joint venture, they remain separate companies. That's the big difference. They became partners with ExxonMobil in 2012, removing carbon dioxide from the exhaust of Exxon's power plants. In 2019, the two companies expanded their joint development agreement. So that's good. They had success with Exxon. They started working with Toyota in 2017. Their hydrogen project will be used in Toyota Mirai sedans. Mirai is Japanese for future. In 2017, they started working with the Office of Naval Research. That's part of the US Navy. In 2018, they earned a $1.5 million grant from the DOE to develop the company's fuel cell technology to aid the nuclear industry by by converting excess power into hydrogen. Looks like they have lots of partnerships, lots of big things. So let me know what you think of the format of the video. Leave a like, subscribe, comment below. Thanks for watching.